It's getting a little bit soft as well for the markets. Let's just bring up the Nifty and show you where we're currently at. It started off quiet, and from there we're down about actually 0.3%, 25,340. So we've taken out the 23,000 or 25,400 level in trade. The pressure points today, even pharmaceuticals, much unlike yesterday. Today they are actually weighing heavy on the market. Cipla, for instance, is down. You are seeing some of the consumption plays like Tata Consumer, Nestle, Titan, etc. as well weigh heavy. And then, of course, Infosys, ICICI Bank, Kotak, TCS, HDFC Bank, Bajaj Finance, M&M. It's the blue chips and the heavyweights which are also weighing down on the markets as we speak right now. The breadth of the markets largely even, Stephen, but that also is now tilting a little bit in favor of the declines, although there are the Adani names which are still holding out. Adani Enterprises, Adani Green, Adani Power, Adani Ports, etc. still in the green. And idea ahead of that Supreme Court hearing on the AGR dues, that's also looking strong, about 1.6% higher for Vodafone Idea as we speak right now. But let's talk about the state of the economy. We've got Alka Anbarasu, the Associate MD at Moody's Ratings, joining in on the show right now. Alka, hi, morning. Welcome to ET Now. Alka, there is a sector-wide growth which is seen in retail loan and microfinance, with concerns such as rising delinquencies, asset quality risks, etc. Tell me, how is it that you're seeing the overall NBFC landscape positioned right now?
Yeah, thanks for having me on the show. From an NBFC sector perspective, this sector has grown quite sharply in the past few years, outpacing even the banking sector credit growth. And clearly the NBFCs target the retail segment where the leverage has increased, but also the push for financing has also increased from the lenders. So to that extent, for the NBFC sector, we do see their asset quality deteriorating on the margin. We expect this deterioration would come from a healthy level right now, and we expect perhaps NPL ratios to increase by 20 to 30 basis points in this year. And quite a lot of this deterioration we expect would come from segments that have been talked about for a while. So whether it's microfinance or lending to subprime borrowers, even subprime mortgages, and also the education loan sector.
Okay, so that's the take coming in. Alka, also help us understand vehicle financing. Let's talk about that. Vehicle finance stage 3 ratios are already rising, and GST cuts will lower new vehicle prices by about 7 to 10%. On the back of all of this, do you expect vehicle loan delinquencies to rise further? And what risks could this pose for lenders as well?
So I think from a risk perspective, perhaps if we step back, on one hand, India's economic growth has been quite strong, and we expect the economic growth to remain even strong for the rest of the year with real GDP growth of around 7%. Having said that, the tariff outcomes have obviously created some uncertainty for certain sectors such as gems and jewelry or textile and also shrimp exports. And we expect that while one of these is sectoral level issues, but also individuals who are working in those sectors would have borrowings from the NBFCs or banks. So to that extent, even the tariff outcome is creating some risk on the horizon for the sector. On the commercial vehicle, we expect the delinquencies to increase further. This increase is coming from a level which was again quite healthy, and we saw a lot of improvements in the sector in the past few years. But the commercial vehicle sector is extremely linked to economic growth, the GDP growth, the outcomes of the agriculture or the monsoon season as well. But we across the board, for most players, we are seeing an inch up in delinquencies even for the commercial vehicle loans.
All right, Alka, but along with that, given that the credit stress of subprime mortgages are likely to increase, what is the projected deterioration in asset quality for affordable housing portfolios at NBFIs in fiscal 2025 and 26?
So first, to step back, the affordable housing portfolio of NBFCs, perhaps within the whole scheme of things, it's small. It is growing, but it is still small. It would be, even in general, be less than 10% of their loan books. For some NBFCs, it may be higher. So from a big picture quantum perspective, this is not the most important or the biggest segment, but the delinquencies are rising, and particularly for some monoline NBFCs, we have seen even delinquencies double in the past year. But for our Moody's rated portfolio, we expect a gradual increase, and we have put out some numbers. We expect 20 to 30 basis points increase in delinquencies across the NBFC portfolio. But within that, the key contribution would be the subprime mortgage or MFIs or education loan sector.
Along with that, Alka, the gold loans, that remain the lowest loss product with charge-offs under 0.5%. But RBI has tightened LTV and provisioning norms from April 2026. Will this materially slow the growth in the gold lending? Do you believe so?
I think for one of the key driver of the growth in the gold loan segment is the gold price itself. The value of the underlying collateral has increased and it continues to increase. If we were to step back and look at the industry data, for some of the large gold financiers, and there are 2 or 3 very large ones in the industry, their gold assets under management or the amount of gold jewelry that they have pledged as collateral has not really increased much over the years. Perhaps in single digits, the increase has taken place, but the gold loans have increased by more than 20-25% for some of these companies. And the reason for the increase is this increase in gold prices. So to that extent, as the gold prices still remain quite solid, we do think that the underlying growth prospects would remain strong. Some of the RBI measures, such as the all-in LTV, will perhaps in the near term limit growth, but we think these measures are here to have a more robust risk management of the sector because of the growth also that it has seen, and also because of the customers that the gold financiers target. We think these measures are here to maybe make the sector more prudent, but overall growth would still remain strong for the gold financiers. And actually, we don't have asset quality concerns considering the fact that the value of the underlying collateral has been increasing.
But Alka, provisioning costs and higher credit charges have also already pressured the sector profitability this year, right? Do you see credit costs normalizing soon, or will profitability remain under pressure for a few more quarters?
So credit costs, we think, would inch up, and that's also coming from normal seasoning because loan growth for NBFCs has been strong over the past few years, and there are perhaps sectoral specific issues. Household leverage in India has gone up. So to that extent, we do expect credit costs would continue to inch up. On profitability, there is another driver, which is the net interest margins. And on that front, the NBFCs are better placed than banks because RBI has cut rates quite significantly through this year, and borrowing costs of NBFCs should come down as the rate transmission takes place. On the other hand, quite a lot of lending of the NBFCs tend to be fixed rate loans. They don't reprice so quickly. So on the margins, there is some upside for the NBFCs, but on the credit cost, there is downside. But all in, we think the margins would outweigh any increases in credit costs.
Okay, Alka, appreciate you joining us and thanks for your insights today. Good chatting with you.
Right, thank you.